Better System Trader, episode 42.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 42, and I'm your host, Andrew Swanscott. Did you know that traders just like you have been competing in World Cup Trading Championship events since 1983? There's no entry fee to compete, just fund your contest account with a minimum of $10,000 in the futures event or $5,000 in the Forex event and feel the excitement as you compete with traders from around the world. You can get more details on the show notes page, bettersystemtrader.com/42. And now on to the show. Today's chat is with Murray Ruggiero. He's the Chief System Designer and Market Analyst at Tuttle Wealth Management, which has around $200 million under management. He's one of the world's foremost experts on the use of intermarket and trend analysis to locate developing price moves in the markets. He's also a speaker, author, and has been a contributing editor to Futures magazine since 1994, producing over 180 articles. In this episode, we discuss various aspects of system development, including optimization, curve fitting, and creating robust strategies. We also discuss why your strategies must have a premise, the importance and applications of intermarket analysis, cycles, and a bunch of great questions from the audience. Also, after our chat with Murray, I'll let you know about a special deal for Better System Trader listeners, so keep an ear out for that one. So let's get to it. I hope you enjoy the chat with Murray Ruggiero. Hi Murray, thanks a lot for joining us today. Can we please start with a little bit of background on yourself?
Okay. See, I actually did not come from the financial community to begin with. My background is I have an undergraduate degree in physics and an undergraduate degree in computer science. And I ended up getting sucked into this whole financial community due to my work in artificial intelligence. After I got my first degree in physics, I started working at Olin Chemical, and I was helping the researchers use artificial intelligence to mine the databases of test results they had. And one of the scientists there, I was buying all kinds of products because this was Olin, so Olin gave me, the money to go try out any sort of AI product I wanted. I mean, if it was $5,000, it wasn't a big deal. This is, a billion-dollar corporation. And I would buy the stuff, and I'd figure out how to use it, and I'd show them how to use it. And I had one of the scientists there, which was actually my dad's boss. My dad worked at Olin also. Basically threw the manuals back at me and said, "Isn't there any damn thing I can use in my spreadsheet?" And that is what gave me the seed to develop a product called BrainCell, which I developed in the late 1980s at Promised Land Technology, which I co-founded. Now, BrainCell was originally a neural network embedded into a Lotus clone that we actually wrote the C++ code for, the C code at that point, really. But what we figured out was that, Lotus was fading and Excel was coming on. So we re-released that product as an Excel add-in. And I also received a patent on the concept of embedding a neural network into a spreadsheet. Now, we were at the Excel 3 and Windows 3 launch in Boston in 1991. And we got a lot of press during that early time. We were in Business Week, we were in Wall Street Journal, and a lot of people that were involved in the financial markets wanted to use our neural net product to develop trading systems. And that's how I got involved in trading, was because I had to do support for these clients as well as consulting for these clients.
Okay, so going from there, how did you get to what you're doing today?
Well, what ended up happening, there were some issues with Promised Land and my partner that I'm not going to go into, but I ended up leaving Promised Land in 93. And in December of 93 or January of 94, I ended up calling Ginger Zell at Futures magazine. And offered to write some neural net-based trading articles for her because I knew that the person she was having write them was no longer going to be writing those kind of high-tech articles for her. So I knew there was an opening. And I ended up becoming contributing editor very shortly after that in July of 95. Now I knew that I wouldn't have a long career in this field if I stuck with the artificial intelligence, because I knew at some point the interest in that would fade because it wasn't being very successful, but they weren't using it correctly. And once that occurred, I was going to have a problem. So I ended up trying to learn as much about different types of technical analysis as possible in order to be able to give myself longevity in the business. In 95, I started working for Larry Williams. I was doing the futures conferences, and I started to work for Larry Williams. And I was basically my job was basically to do research for Larry. So I was Larry Williams' basically right hand in doing research projects. So he would tell me, this is what I've done on this topic before. I don't want to see this again. Try a different approach. And I worked for Larry from 1995 until 1999. And that's how I got into the business where I am. After working for Larry, I continued to develop product for myself. And at that point, through the mid to late 1990s, I was one of the top TradeStation developers. In fact, I was featured on Omega Magazine as their fourth cover. I used to actually, at the conferences, I would tour with Bill Cruz, and he would bring me out in the Dog and Pony Show as a TradeStation developer that was making a living selling TradeStation add-ons, which was part of the dream back then of people that bought TradeStation, was that they could buy a copy of TradeStation, write some code, and quit their job and be able to play with trading full time.
Yeah.
So that's how I got to where I did. Now, one of the big things I had, which was a big advantage, is my father was a research scientist at Yale University when I was growing up. And I would go to work with him during the summers. And I was in that environment with all those Yale professors. So these brilliant Yale professors were kind of my babysitters. So I learned a lot about how science worked and the scientific method. And that gave me a big edge because it allowed me to approach system development differently than most everybody else.
So as you've mentioned, you've had quite an extensive career in system development. Before we get into some of the particular aspects of your research, let's have a quick chat about system development in general. Now, you've mentioned one of your edges there was having a scientific background, but what else do you think contributed to your success in terms of system development?
Well, I mean, part of the issue is having a broad background. Like, for example, a lot of system people, the system people didn't understand scientific stuff, signal processing issues. What does the lag in a moving average really do? I think one of the classic examples is that if you have a half period moving average minus a full period moving average, theoretically you're 180 degrees out of phase with the market. Every time the short-term moving average crosses above the long-term, you would want to sell. And every time it crosses below the long-term, you'd want to buy. And of course, the classic trend following system says the opposite. So if all of a sudden the system isn't working, if you didn't understand the signal processing part of it, you wouldn't understand why it's not working. Other things deal with, for example, psychology. How do you ask the question about what is making a system work? And there's an area of science that goes back to the 1800s called natural philosophy. And if you ever read these natural philosophy books, and some of them were written, 1820, 1810, there's a lot of things, including like how atoms work and how electrons work, that people actually postulated and came up with their own theories, even though there wasn't equipment to actually prove any of their theories. They actually used the Socratic method and asked themselves questions and reasoned how nature worked. So I had a background in those areas too, plus the strong scientific background. And I think one of the things is the ability to put together unrelated fields and understand the underlying theory of things. I had a physics professor, Dr. Charlotte LeMay, who was one of the top physicists in the world, and she used to always give one essay test in physics. Now, physics is basically a very equation-driven thing, but she would give one essay test, and she said, you know what? The people who don't understand the underlying theory completely will fail this test. And that's what always happened. It's a key to understand the theory. In fact, one of the things that Larry and I have always talked about is when you build a trading system, you need to understand the premise of the system. And that premise, so you don't build a system by just throwing darts at data and trying to get something that back tests, or data mining. Now, data mining does have its place, and that's probably beyond today's talk. But that's not what your intention is. You want to build a theory. I'll give you a very simple example. I did a lot of work with report days. And what I did is I looked at the report days and I had an underlying theory. If the market was going up into a report, I wanted to sell. If the market was going down into a report, I wanted to buy. And the underlying theory behind that is people overreact. So when I tested out my rules, now think about this. If we're making the thing that people overreact, that means if the market's going up into the report and it's more bearish than expected, you're going to win when you sell. If it's as expected, since you're only trying to capture a small profit, you'll also win, because if people overreacted and the report was as expected, you're going to get a short down. The market's going to go down for a short period of time. So 2 out of 3 cases, you would be correct. So when I tested out my theory, I won 63% of my trades. Now, considering the fact I didn't know if the distribution of those events was normal, that was very reasonable for my theoretical answer. But I didn't stop there. Now, what was my underlying premise? People overreact. So if they overreacted, that meant that the volume going into the report had to increase. Because if they weren't excited or scared, they wouldn't be trading, which meant my theory was wrong. And when I did the analysis, I found out that volume did increase going into these reports. But if volume had not increased, let's say volume had dropped by 50% going into the reports, I would have thrown out a system that made money because the theory was wrong. It didn't matter the system made money. My model was wrong.
Okay, but seeing that, if the model didn't confirm your underlying understanding, could you change your understanding to suit the model, or is that just you scrap the model from there?
Well, it depends on how. Okay, I'll give you another example.
Okay.
I do a lot of work with intermarket analysis, and I invented a technique in the mid 1990s that I call intermarket divergence. Now, the problem with commodity data is everyone uses back-adjusted futures contracts because they want to do long-term backtests. But when you do a back-adjusted contract, you maintain the range of the day because profit and loss in futures is based on range. It doesn't matter what the percent return is in futures. The percentage change. You don't care if you're trading the futures market that you made 1.5% on coffee. That 1.5% is 6 cents, let's say, and that 6 cents corresponds to $2,200 or whatever in profit. So because of that, because you're using these back adjusted contracts, ratios don't work because they're invalid. Ratios are invalid when you use back adjusted contracts. You have to use ratio adjusted or split adjusted in order to be able to use ratios. And no one uses ratio adjusted futures contracts because the dollar returns are wrong. So I needed to come up with a method to do intermarket analysis that could deal with that for the commodity market. So what I basically did is the only time that you know that things are out of whack is when one market, for example, if you have if you're trading bonds treasury bonds. And bonds are below their moving average, but utility stocks are above their moving average. That's a divergence, because utility stocks and bonds prices should be positively correlated. So I used a simple oscillator and a zero crossing to tell me if bonds are in an uptrend. So if bonds are in an uptrend and utility stocks are in a downtrend, I want to sell. And the reason for that is this simple zero crossing gave me an arbitrage trade, because when they're heading in the wrong direction, that's an arbitrage. So in essence, intermarket analysis is statistical arbitrage. So that's why I have a lot of systems I've done with intermarket analysis, and they work very well. Now you're asking, what does this have to do with modifying your theory? Now, John Murphy and I, back in the 90s, talked about the fact that these markets decouple. One classic example was in 1993. In the summer of 93, bond prices exploded when the CRB index also went up. Now, the CRB index went up. The CRB should be negatively correlated to bond prices. So we would have expected bond prices to go down because the CRB was going up. But what we found was a concept we call intermarket inversion. And the underlying concept we had for intermarket inversion was when a market moved more than 2.5 standard deviations from its means, the intermarket relationship's inverted. And we actually used machine learning to test the concept. We gave these oscillators and standard deviations to a machine learning algorithm called rough sets, and came up with rules that put at 2.6 sigma, it inverted the intermarket trading rules. Now, my theory was that when they moved too far, the rules inverted, and 2.6 sigma made perfect sense. So in that case, we could modify an underlying theory that didn't quite meet, because we developed a theory, and that independent new theory we had to prove, which was the exception to the rule. And the underlying logic to that is, if interest rates are falling too fast, people start getting fear of inflation. So that was a valid premise. We didn't have to torture the data to end up having a premise that worked, that made sense. Sometimes you've got to torture data, and when you have to torture data to make a premise work, then you have a problem. So that's my whole thing. You need a valid premise, and that's actually something that Larry and I always discuss. Because as Larry used to always say, market data is like POWs. If you beat it enough, it'll tell you anything you want to hear. No, but that's, I guess the whole key is, if you want to have a valid premise, and if you have a valid premise and you understand the premise, then you can build systems that you're comfortable with. I'll give you an example of one of the things I do a lot, because I know that everyone wants to ask me about curve fitting.
Sure.
Well, one of the things I'll do when I build intermarket systems, in fact, I actually have a tool that's free on my Using Easy Language website, that you can test one intermarket at a time. But I actually have another version of the tool that's available that I've used for over 20 years. And what I'll do is actually shotgun. I'll test a whole bunch of intermarkets that I think possibly would have correlation. So if I'm trading bonds, I'm going to be testing the CRB. I'll be testing gold. I'll be testing silver. I'll be testing copper. I'll be testing different interest rate utility stocks, utility ETFs, utility mutual funds, in order to find things that are predictive of bonds. And when I optimize these over big ranges, so I'll be testing my parameters from 2 to 30 in steps of 2 for all these markets, maybe 10 or 20 at a time. What I'm looking for is how many times each market appears in the top 10 or 15% of the combinations. Because if I find a market that dominates, that is in half or more of those combinations, that's the first market I'll end up using in my analysis. And then I'll start to continue my development with that market. So I'm using the optimization to tell me which markets are the most stable. Another thing I do when I optimize is I don't use optimization like everybody else does. It's like, oh, this is a good set of parameters, I'll pick it. You got 2 or 3 avenues. One is I'll optimize over what I consider a valid range.
Mhm.
And a valid range depends on how often I want something to trade, what's the average trade length. There's a bunch of things like that that I'm looking at to pick a range of parameters. And I'll say for that valid range, what is the average net profit for all combinations, including the losing ones? What is the standard deviation of that net profit? And I'm looking for a system that is performing at least 2 times the standard deviation of the net profit and is still profitable across all sets of parameters that you optimized over. So if you tested something, the best combination made 200,000, the worst combination lost for 50,000, average was 120,000, with a standard deviation of 40,000, that would be an acceptable system. Not by much, but that would still be an acceptable system. So I'm including every single test in order to judge if the underlying system is robust. And that simple test, which is a lot like a standard, F test in statistics, is really pretty powerful to tell me if something's going to hold up. Because a lot of concepts will fail that.
Okay, great. So if we can just jump back to intermarket divergence a little bit.
Okay.
Just like to chat about the application of that a little bit more. So you mentioned there that you're looking for correlation between markets that kind of make a logical sense to you. But is it best to use markets that have high positive or negative correlation or not?
Well, you want to use markets that basically, quote unquote, make sense.
Okay.
Like for example, there is more work done in the stock arena in terms of analysts than there is in the commodity arena. So the richest supply of markets to predict underlying commodities are actually stock indexes that are correlated to the commodities. So, the XAU for gold, for example, that's something that's very well correlated. Oil exploration stocks to predict crude oil. Those are a rich source. Utility stocks to predict bonds. Now you're worried about inflation, so you'll actually see, different inflation measures: gold, silver. If you're trying to forecast tip ETFs, you're going to use an inflation measure. Now the problem is some markets are manipulated, others aren't. I'll give you an example of one that was pretty interesting. And this is also why you have to understand what's going on. One of the markets that's good for predicting bonds was the Fidelity Select Chemical Index. At least I haven't looked at it in a few years, but at least I would say through the early 2000s, it was very good. And the reason it was very good was that U.S. chemical companies are basically a commodity play. And that's why it was predictive. When chemical stocks went up, when chemical stocks and bonds were both going up, you wanted to short bonds because the chemical stocks going up was a sign of inflation. Now, here's the thing. So let's suppose you're building a model using this Philadelphia Select Chemical Index. And all of a sudden, the money manager for that index decides he's going to start integrating European chemical companies. Well, if you understood that U.S. chemical companies are a commodity play, while some of the European ones are not, you might have seen that I can't use this index to trade anymore. Because my underlying premise, which was it was a proxy for chemical prices of commonly used chemicals in manufacturing, is no longer valid because the money manager changed his allocation. So you need to understand what's going on at that kind of level to be able to build systems that hold up forever.
That's also, I guess, a good way to determine when a relationship has stopped working, if you have an understanding of the underlying premise.
Right. Well, one of the things I did is I did a paper in 2012 at the CFIR conference, which is the IEEE Computational Finance Conference, and I revisited a an intermarket system that I published in 1998. It was trading the U.S. Treasury bond using utility stocks. And I was originally using the New York Stock Exchange utility average. And when that was discontinued, I just substituted the Philadelphia electrical utility average. And I did not change the parameters of the system since 1998 when the article was first published. And the system has continued to perform very, very well over all this time. Now, one of the things I did when I built this system was that I actually did a three-dimensional plot of my parameters versus profit and looked at that three-dimensional surface. Now, if you look at the three-dimensional surface, the surface was very, very robust. But if I looked at the surface to say, from an inflation measure and to say, how did the CRB index predict bonds? Even though the performance of that looked very good, it made almost as much as the utility stocks did, I rejected it because the underlying three-dimensional space was too rough. So looking at a three-dimensional plot of different parameters versus profit will give you an idea about how robust the underlying relationships are.
Mm.
And you could predict which relationship will hold up well into the future.
Mm. That's interesting. Thanks, Murray. So before we move on from intermarket analysis, if I can just ask, for someone who wanted to get started with researching intermarket analysis, what would you recommend?
Well, as I said, I've done a lot of work with intermarket analysis. So I have a lot of Futures magazine articles that I've published on the topic. John Murphy's few books are very good also, and that'll give you some of the underlying theoretical understanding. The few books he's done on intermarket.
Mm.
Now, basically, what's kind of funny is when I was back in the 90s, I was on CNBC when John was on quite a bit. I was on maybe every 6 or 8 weeks with John because, in essence, I validated a lot of the work he did. He would point out a relationship in the chart, and then I would build a trading system around that relationship. So he would have me on television to basically say, well, I've been talking about this relationship for the past 2 years, and here's a system Murray built around it. So Murphy's books, I have a lot of Futures magazine articles.
Yep.
I'm covering a lot of the stuff too on my website. I'm going to do a lot more intermarket work because I actually think it's one of the most important areas in trading is intermarket analysis. Now, intermarket analysis is also interesting because it's a counter trend method. It's one of the counter trend methods. And combining trend following systems and counter trend systems in the same account will help your drawdowns and give you a more robust equity curve.
Mm. Yeah. And are there any common issues or mistakes you see traders making when they're doing intermarket analysis?
Well, one of the things, and this was really interesting, I had a client of mine that was a client for a long time, and they built this wonderful intermarket system that really outperformed the stuff I was doing, but it blew up out of sample. And what I actually realized, and this is actually, this whole thing happened about the time I decided to write the IEEE, which is a peer review article on my intermarket divergence method. Basically, here is 15 years of research in intermarket divergence, and the method held up. Because what I realized was what I had was special, that my intermarket divergence systems have been robust. They have held up. When doing things like looking at, utility stocks are above their moving average. So now I'm going to try to, find the spot to buy bonds on a breakout. Well, those kind of rules didn't hold up. They might have performed really well, curve fitted, but they didn't hold up.
Mm.
So that was really, one of the big issues that, prompted me to begin to have peer review of the methodology.
Yep. All right. Thanks a lot, Murray, for sharing some insights on intermarket analysis there. So now another one of the trading aspects that you've produced is the adaptive channel. So can you explain a little bit about what that is and how it came about?
Well, what ended up happening is back in the mid to late 90s, I worked for Larry Williams, and I did a lot of research for Larry. And one of the things I developed when I was working with him was this concept. He asked me, well, how can we set a channel breakout length. How many day high, how many day low to use, that adapts to the current market conditions so that we don't get whipsawed, and that it works with the same parameters across a variety of markets. And I thought about the problem, and here's another theoretical premise issue. So I was doing a lot of work with cycle analysis. Now, there's a lot of cycle methods. Back in the 90s, MEM, which John Ehlers championed, was one of the main methodologies. And actually, MEM is, he called it MESA, but it was actually the maximum entropy method, which was the Berg algorithm, which was actually used for oil exploration. But he adapted it to trading. And I worked with that algorithm also and built my own version of it. Now, here's the concept. If you know the cycle length, you now can define trend. So let's suppose we have a 30-day cycle. If we have a 30 trading day cycle, that means we expect the market to go up for 15 days and down for 15 days. So let's suppose we set a 20-day high. Well, that 20-day high is more than we would expect if the market was in cycle mode. Yep. And if we come up with some level, maybe it's 20 days, maybe it's 22 days, in which we violated the concept of random walk, that's now a breakout and the market is in trend mode. So that's the concept of adaptive channel breakout. We're buying at the highest high of some multiple of the dominant cycle, and we'll sell at some multiple of the dominant cycle low.
Okay, but how do you determine then when a cycle has changed?
Well, because this MEM algorithm is constantly changing the cycle. It's constantly monitoring the spectral content of the market, and we're looking at the cycle that's got the most energy, the spot in the spectra with the most energy. Now, over time, there's been a lot more cycle algorithms. There's people using Gaussian, which is a discrete Fourier transform. There's people using correlation periogram. There's a lot of different methods for cycle analysis that weren't used on trading computer-based models until the past 5-6 years. And as I said, Ehlers has done a lot of work in this area, and John and I are friends, and we've shared stuff over the years.
Okay, so you're talking there about identifying the cycle length to adapt a channel, but what other applications can that have to trading systems?
Well, here's another application. In fact, I use it with that. One of the classic stop mechanisms is a decay stop. The longer you're in a trade, the closer the stop gets. Well, you could use cycle-based tools. In fact, I actually wrote a cycle library for TradeStation that's all in native easy language code that should be available later this year, where you could actually now decay as you're in a trade longer and longer, the stops get closer and closer. So if you know what the dominant cycle is and you know how long you've been in the trade, you can move the stop closer and closer over time. So these kind of decay stops, where the decay is based on the current length of the dominant cycle. So the longer the cycle, the slower the decay, and the shorter the cycle, the quicker the decay. That technique works very well.
Yeah, that's very interesting. So for someone who wanted to get started studying cycles and the way they can be applied to trading strategies, what would you recommend they do?
Well, I've got a lot of stuff coming out shortly. I mean, John's books are very good. I've got a lot of things coming out, including a cycle product that's got open code. One of the things that I do on my Using Easy Language site, and even the stuff I do with Trader Studio, the systems, is I believe in open code. I honestly believe that unless somebody can understand how a given system or strategy works, there's no way they could trade it through a drawdown. So I don't believe in black boxes. I'll have people sign non-disclosure over trading methods that I've developed, but I don't like selling black boxes because I don't believe that somebody can trade through a drawdown when they're trading a black box. One of the things I developed recently was a lot of people used opening range breakout up through, recent times until all the pits closed. Now, there's a lot of commodity traders that used opening range breakout. Now, since we have 24-hour markets now, opening range breakout no longer works. So I developed a methodology I call dynamic open, which gives me a time of day that the market every day it changes, but it tells me at what point there's a valid bar in the market that represents a statistical open that I can set a breakout off of.
Mm.
And that's based on price and volume patterns. Now, I released this methodology using a non-disclosure that clients had to sign, and it trades all the commodities like used to be traded back in the 80s, and it works really well. I actually just pulled that product from the market for a while because I sold enough copies that I don't want to undermine it.
Yeah. Okay, so we're just going to take a really short break here. We've got some fantastic questions from the audience coming up next and some interesting answers from Murray too. But before we get to that, I'd just like to share a very short announcement about the sponsors for this episode who are helping to support the show. This podcast episode is sponsored by the World Cup Trading Championships, considered by many to be the gold standard of real-time, real money competitive trading. We've been fortunate to have 5 former World Cup trading champions join us on previous podcast episodes, and they'll all tell you that the World Cup competition can be life-changing. Enter today to learn how your trading stacks up against your peers and how you hold up under competitive pressure. There's no thrill quite like seeing your name on the championship leaderboard throughout the year. And you might even make a few trading buddies along the way and take home a magnificent pewter or crystal Bull and Bear trophy. So why not make your futures or Forex account a World Cup Championship account? Visit the show notes page at bettersystemtrader.com/42 to learn more. Now back to the show. Okay, thanks, Murray. So now I'd like to move on to some questions from the audience.
Okay.
So first we'll start. There's a couple of common questions among all of these. So I think we'll start with those and get into the more specific ones a bit later. But one of the common questions was how to detect if a system begins to fail. So at what point and how will you decide whether the system is broken down or the current losses are part of a normal drawdown?
Well, there's a bunch of things that you want to be looking at for a system. And I actually wrote about it way back in the 90s, that a system has a footprint or a DNA. It has an average distribution of trades. It has an average win-loss ratio. It has a winning percentage. All those underlying statistics you don't want to see change. When you see that footprint change, the system's DNA, that warns you have a problem. Now, what's really funny is when you're looking at the system in terms of its historical distributions of performance, it's possible that it might change and perform better than it did in the past. And that would still be a warning to me. So the way I look at it, I might turn a system off because it's doing too good. Because if I have a trend following system, for example, so my average win-loss ratio is almost 3, and it wins 40% of its trades. Now, all of a sudden, if it starts winning 70% of its trades, and its win-loss ratio is now 1.2, even if it's making money now, I'll stop trading it because its footprint has changed. Another thing that people don't realize is they say, well, if a system sets a new drawdown peak, does that mean the system is broken? What they don't realize is drawdown is proportional to the square root of time. So if you back tested a system over 4 years, your drawdown is going to be 2. If you back test that same system over 20 years, it's that the square root of time is now 4 point something. So you would expect a system that was back tested over 2 years and a system that was back tested over 20 years to have twice the drawdown, the 20-year system. That's acceptable.
Yeah, okay. Thanks for that, Murray. So another common question in this list is robust strategies. So people would like to know, because you've been trading for such a long time and you've developed lots of different types of strategies, which ones do you think work the best or have stood the test of time?
Well, my intermarket work has been very, very robust. Even though it's new, I think that my dynamic open methodology is going to work very well. There's a lot of pattern work that has held up, and the thing is, these patterns have to be based on psychology, or mechanics of the market. Like for example, there's actually patterns that have occurred in ETFs currently that are related to the rebalancing of the levered funds. And there's actually patterns within the market, in day trading patterns, to know whether or not the last hour of trading is going up or down based on this rebalancing of the market. So you have to understand the psychology. So the point is there's lots and lots of methods that can be robust as long as there's an underlying strong theory.
Okay.
There's work now in sentiment. There's people that are working in sentiment, using things like Twitter. So there's more and more information coming, and also artificial intelligence is coming along into the markets. So now we have the ability to do more research in the markets. Now, when you do data mining, you need to understand whether your theories are valid. So you need to ask questions when you use artificial intelligence to develop trading models. And you want the artificial intelligence to answer those questions. You don't let AI just go rapid and come up with what it wants to. You formulate a hypothesis and a question, and then use artificial intelligence to either come up with the underlying rules and see if they make sense, to combine multiple trading methods. Artificial intelligence can be used to predict if a current method is not going to work right now, because every method works in different phases of the market. One of the issues with trading methods is robust trading methods will work for quite a while and then look like they blow up. They'll have a really bad year, or maybe a bad 2 years, and then work for another 10. So what happens is these methods, like trading gaps, for example, these methods will go away for a few years. No one will use them because they didn't work so badly. And then somebody else will curve fit out that bad period, and the method will be reborn. But the truth is, they just didn't work in that period. So now if you can predict periods that these methods won't work, you can switch between methods. And that's one of the more exciting areas in terms of trading right now.
So do you actually do you employ like a regime switching algorithm yourself to determine when to follow different types of strategies?
Yes, we're beginning to do a lot of research on something called hidden Markov models. Because that's where a lot of the regime switching stuff is going right now. And I actually think that the hidden Markov models is going to be one of the most exciting areas in trading over the next 20 years. It's really funny. In 2001, I wrote an article on where trading and artificial intelligence was going. And I said that game theory was going to be the most exciting area in trading over the next 20 years. And what ended up happening was the game theory was used to do high frequency trading. The core of all the high frequency trading methods is game theory. And I wrote one of the articles I did for Futures last year covered this topic.
Okay. We've actually got a question from Nikhil that's kind of along the lines of that. It's a little bit long, so let me just try and summarize it for you as I read it. But he says that in the 80s, the trend following was big and everyone started or became a trend follower, and perhaps the performance of that strategy has degraded over time. And now the same is applicable to quant trading, where everyone is interested in or is a quant trader, and results of strategies seem to be degrading with the passage of time. For instance, HFT profits seem to be decreasing the last couple of years. So maybe as an industry veteran, what do you think is the future of trading?
Well, here's the underlying issue. What I think the future of trading is to be able to come up with real models. Now, let me explain to you what I mean by that. Let's look at weather forecasting. Most of the trading system models right now are observational models. So I would relate this in weather forecasting to: there's a ring around the moon, it's going to rain within 48 hours. There is frost on the ground today, it won't rain today. Now, a lot of these things are statistically valid, and then they give you an edge. You can have an edge in terms of forecasting over 50-50, but they're not very good. And all of the technical analysis right now, or most of it, is observational. Now, weather forecasting went from that observational meteorology, where we were just looking at surface maps, to computer models. And what's really funny is, and we're talking about things degrading, is the first time they tried to build these advanced computer models for weather, they failed miserably. And it actually took 30 more years before we had the first models were back in 1940. They used a vacuum tube computer to try to forecast temperatures only a day or so ahead.
Mm.
And the model went on and oscillated and produced ridiculous numbers. It told you that it was like the sun. And after that, it wasn't until the 1960s that we actually had a valid model that a computer did to forecast temperatures only a day or so ahead. So trading is in the same spot right now. The thing is, we don't have physical equations to predict the markets. So artificial intelligence is going to be used to actually model the markets. And then all of these individual models will be put together. And we'll actually build a model of the markets that's predictive.
Mm.
So in some ways, people are saying, well, that's going to be curve fitting. But remember, I'm talking about a premise. So if I have a premise, I'm okay. Like, for example, interest rates, long-term interest rates are based on current inflation, the fear of future inflation, plus a premium that the bondholder gets for tying his money up. So if I'm modeling using artificial intelligence what I consider the future risk of inflation is, and have a model of current inflation as perceived by the trading community. Because here's another real interesting thing. I did a lot of work with shadow stats a while ago. And what was interesting was I couldn't build any systems out of shadow stats because people don't follow those numbers. I mean, I figured, well, the real statistics should give me a better view because nobody uses them. Well, unfortunately, that's not the case.
It's interesting.
So that's where trading's going. We're going to be building models. We're going to be building these models that based on artificial intelligence, we're actually trying to find the algorithms and combining them. I mean, I'll give you an example. One of the things I've looked into is modeling the markets using the predator-prey equations. So you could twist that predator-prey model several different ways. We could be looking at the predator being the high-frequency traders, and now design a model in which the predator is the high-frequency traders, and the prey is the long-term position traders. And we could try to maximize how much food the predators get if I was a high-frequency, trader. So these more advanced models is where we're going. Now, it's going to take time to get there. It might take another 25 years to get there.
Okay, a kind of related question from Sven regarding computational requirements. How strong are the technical and computational requirements changing in the markets over the years? And will the computational side grow fast as in the last 2 decades? Or have we reached a maximum turning point today?
Well, I actually see long term that models being developed with more and more processors. Like, for example, my Trader Studio product, which is actually what I use with Tuttle. Tuttle builds all the models that I've developed for Tuttle sit on top of Trader Studio. And part of the reason for that is in Trader Studio, I've actually solved the problems of splits and dividends in stocks. What happens is if you use split only adjusted data, what happens is you have to buy the same dollar value of each stock. And that once the dollar values have diverged, you actually can't run it on a portfolio. So you need to have so you can't get stopped out of one of the stocks because now you've basically, so you're in that stock for part of the time. Now the portfolio numbers don't come out right. So I developed logic and mathematics to be able to handle the splits and dividends correctly. So in Trader Studio, if a stock splits in the middle, you'll see you bought 100 shares at $100, and sold 200 shares at $52. You'll see the dividends also get taken care of. And you'll be able to do advanced money management on equities and dynamic rebalancing on equities inside Studio. And we use CSI data for that because they're the only ones that will let me process the data the way I need to. I use split adjusted only. I don't roll splits and dividends together. Then I use dividend only, and I use unadjusted. And I combine all three of those to do my modeling. And a lot of people will roll the splits and dividends together because when you have dividend only adjusted, you're in essence giving away the split data. You're giving away the dividend database. And a lot of the data vendors won't do that. CSI is willing to do that because they're worried about the analysis being done right, not, trying to, hide the data from their customers.
Mm. Okay, thanks. So you mentioned Tuttle there. Now
Yes.
you're currently the chief system designer for Tuttle Tactical Management,
Right.
which manages over $200 million, I guess. So
Yeah, it's a little over $200 million, and we have two ETFs right now, TUTT and TUTI.
okay. So there's a question regarding Tuttle here, saying the fund has suffered about a 10% loss since inception. Now, can you explain why your strategies will work better for a retail trader compared to an institutional?
Yeah. Well, I really like this question. Now, first of all, the way I want to explain it is managing money for other people, especially in the retail environment, really has nothing to do with how well your trading systems work. Here's the underlying problem. I had some strategies. I've worked with Tuttle since 2007. And in that 2008, 2009 area, we had some strategies which were no longer trading, and I'll explain to you why in a minute. Not because they didn't do great, but because from a retail standpoint, customers wouldn't stick with them. We actually had strategies that in the 2008-9 sell-off went short, and people were actually up during the sell-off. And then what happened was our strategies didn't get back in the market until June of 2009. And because we lost that first 20% of the rally, a lot of people basically, took their money back. Now we were still way ahead of the market because we missed the decline and actually made money during the decline. But people don't want to see the market up 3% and you flat, or you down 0.5%. They don't understand it. And if they see that, they're just going to pull their money. They can deal with the fact that if the market's down 10, I'm down 3. They can handle that. But they can't handle the market going up and them not making money psychologically.
Mm.
Now, another thing is if you're in the managed futures arena, the big problem is when you have a little bit of money to trade, a couple $1 million, let's say max, or a $100,000 account, or up to a couple million, you can trade markets like palladium that are not very liquid, or coffee, which is somewhat liquid, but then if you had 50 or 100 million to manage, you can't trade those markets anymore. So your performance really gets worse because now you can only really trade the financials once you're managing hundreds of millions of dollars. So a small trader has an advantage that he can trade these illiquid markets that trend better. So it's a whole different game managing money for other people. It forces you to do things in order to come up with low standard deviation of returns, perceive less risk. You end up making changes. Now, the thing is, over time, you're trying to move to keep the customers happy. So we've made major adjustments to how we're managing things. And I think over the past, 3 to 6 months, we've gotten much, much better than we were when we first started the Tuttle, TUTI and TUTT. Now, one of the things is we're down about 11%, but also the market is down about 11% also. So we're not underperforming the market. And for this year, we're greatly outperforming the market. We've adjusted some things in terms of how we do things, and now we're outperforming the market when the market goes down. And I think we will perform with the market when the market goes up. And that's actually how these tactical managed strategies should work. As I said, you end up learning how to adjust things, but you're trying to learn to adjust things in order to keep customers happy due to these other scenarios. So things get a lot more complex. Now, in the strategies that I sell, an individual trader could trade 2 or 3 strategies. And he understands the market. I'll give you an example. One of the strategies I have right now went short. It went short in December 30th and got out right near the bottom. It was a beautiful trade, but it also went short on Monday and is now in the hole a little bit. Well, the thing is, after that 300-point up day, if I was managing money for other people, I'd be getting calls that people want me to send their money back. But as an individual trader, you'd say, well, I made $4,000 when the market went down in December to early January. I don't care that I gave back, 1,000 of it right now.
Yeah.
I'm still up 3. So if you have that trader mindset, you can put strategies together to maximize your risk-adjusted performance. When you're managing other people's money in the retail trade, you're managing perceived performance, which is nothing to do with actual performance.
Okay, Murray, thanks for sharing those insights into money management. It's quite interesting.
One other point is, and I actually sent you, we have a NASDAQ strategy that we actually have been trading since 2010. And you'll see that has greatly outperformed the market. But that's the example. In these individually managed accounts, we're trading a whole bunch of different strategies because the customer picked and said, I can deal with this risk performance. I understand how the strategy works. So in these individually managed accounts, some of the performances are much, much better because the client is making an aware choice to trade certain strategies of ours versus a more general retail strategy.
Okay, thanks, Murray. So I just might switch over to exits now. We've got a question from Daniel, just basically wondering the impact that exits can have on strategy performance. So what do you say about that?
Well, it's actually an area that most people haven't looked at. The whole concept of exits is one of the least researched topics. And it is a pretty important topic. Now, here's what the problem is. Exits need to be paired with certain entries. So you can't have the book of exits. Because if you had the book of exits, you'd also have to discuss for each exit what type of entry does that exit pair with best. I'll give you an example. Let's suppose the entry method was a counter trend system. So you did something like Connor's RSI system where you're selling, where you're buying when the RSI hits a 3-day low, or a 7-7 system. You hit the 7-day low, you buy. Well, if you had a stop below the market, you could see that stop, even if you developed some smart stop below the market that looked at some support levels or whatever, might not perform well with that counter trend strategy because it would get stopped out too soon. On the other hand, it might work very well with a trend following strategy because you had enough room above the stop level for the trade to work. So when you look at stops, you have to look at the entry method, how long the entry method is predictive, and gauge the stops. So you could create the stop book, but the stop book would also have different stops for different types of entries. Maybe not a specific entry, but okay, here's a bunch of stops that work in trend following systems. This is a methodology for counter trend systems. Now, one of the things that people don't realize about stops is, let's suppose we have a system and we pair it with a stop method. There are times that getting stopped out of that trade tells you that the market is not functioning in the mode it has to be in for your entries to work. I'll give you so let's go back to the intermarket stuff we talked about. My intermarket divergence method is a counter trend method. So if bonds are going down and utility stocks are going up, we're going to buy. Well, let's suppose I have a stop below the market and I get stopped out. Because that intermarket divergence might still exist, because as long as bonds are selling off, as long as utility stocks are going up, I still have the divergence. It might want to get me back in the next day, and then I'll get stopped out again. Do you see the problem? So what I do is I actually have in Trader Studio a function called disable after exit. So I'll take certain stops I've designed that I understand that if I get stopped out, my market analysis, my market mode is wrong, and I will turn off my entries when certain stops are hit. And that area of research is pretty exciting. Now, the problem is, if you're coding something like this in TradeStation, it's very difficult, and you'd have to write custom code for every single variation. That's kind of why I use Trader Studio and built tools that I have in Studio, which of course I sell, but these tools are disabled after exit. So it's now one command line of code. So I put the exit name, the entry name, and the condition to turn the entry back on. And now I can gauge, so now when a certain stop gets hit, I know that the market's not working for my entries, and I can turn them off for 10 days. I could require the RSI to go back above 50 to tell me that the market has had at least a mild bounce before I try to make a long trade again. So that's the problem. That's why no one's ever done a book of stops, because you have to pair it with different types of entries. So the stop book would have chapters where you have a generic entry method and then a list of stops and how to use them for those methods. You couldn't just say that, good exit methods will work. Good exit methods have to be paired with an entry method that matches that exit.
Yeah, that's interesting. Thanks for sharing that, Murray. I think one final question here from Barry. What do you think is the most important element in a trading strategy?
In terms of what? In terms of developing it? In terms of trading it?
I think maybe he means perhaps the rules, entry, exit, position sizing.
Well, here's something that I've learned over the years. And this is also why I like trading multiple systems. Because the closest thing we have to a holy grail are multiple uncorrelated systems. That's the closest thing we have to a holy grail. Because here's the point. The point is, simple systems with minimal filters are the most robust. Those are the ones that will hold up the best. And that's a common rule. So the more you try to, limit drawdown with fancy exits, and the more you're going to get yourself in trouble. That's one thing about systems. The other thing is how good your premise is. I think the premise is the most important part of a system. Like, for example, if you're building, now you say, well, the premise of trend following, how do you deal with that? Well, what you're going to end up doing is you're going to build artificial markets and see how the system performs in all possible conditions, based on the underlying theory. Because that'll show you where the weaknesses in the system are. At what sort of noise levels do you get whipsaw? And then you can apply it to actual data. See, trend following is odd because the premise is there's a trend. Market will continue to move in that direction. So that's the spot where that's the only spot I've ever used artificial data or thought about using artificial data is in terms of building trend following systems. Because everything else I have a premise that's based on, crude oil moves in the direction of, of crude oil stocks. I have something like that, or there's a pattern that has some underlying psychological reason. The trend following is interesting, and I've actually been thinking about testing trend following systems on synthetic data to make sure that they can handle different conditions.
All right, one more question before we start wrapping up for today. So it's something you've covered a little bit already, but in your book, Cybernetic Trading Strategies, you discuss a lot of different types of trading approaches or concepts. Now, that book was published almost 20 years ago, I think. Do you still use any of those concepts in your trading today?
Actually, yeah. The first there's like 2 chapters on there in Intermarket. There's a chapter on cycles. I did some work with mechanical Elliott wave, and I haven't used that too much, but it's actually still interesting. See, one of the things I did is I actually, fuzzy logic and candlesticks, I actually did a system that I developed. It was originally for a client, and now I have another version of it that I have. I called it Pattern Trader. And that was actually fuzzy candlestick recognition. And I built the system around that. So yeah, I've used a lot of the things from the cybernetic book are still useful today. I mean, in fact, I think in some ways the book has kind of come into its own. Even though it's 20 years old, it's actually still a lot of the stuff isn't dated because a lot of the techniques still work.
Okay, thanks a lot, Murray. So we'll just start wrapping up now with some quick closing questions. So firstly, what's the biggest lesson you've learnt through trading?
Well, the thing I always say is the markets are a mechanism to take the most money from the most people and give it to a few people. And that is the underlying premise of the markets. So, for example, let's look at trend following. Why does trend following work? Because it's against human nature to buy when the market continues to go up. Because you figure, well, I already missed the rally. If I buy now, the price is going to go down and I'm going to lose money. So there's a fear factor for people to follow a trend. They've already gotten in late by the time the trend is established, or at least they think they got in late. So that's why trend following works, because it's hard to do. So that's the underlying thing. You have to ask yourself, how is the market going to hurt the most people and give profit to the insiders? And if you understand that concept and what scenario is likely to do that, well, believe it or not, that's actually the concept the market will follow. For example, now that there's all these system trading and everyone can optimize in TradeStation, a lot of classic systems, you can profit doing the opposite for a short period of time. I actually came up with a system a long time ago that was based on an oscillator, and it's a 0 to 100 oscillator, so it gets overbought at 80, and you're oversold when you get to 30. Well, what I did was when I hit 80, I bought, captured a small piece of the range, and then exited the trade. And I used a few other filters. Now, that's the opposite of what everybody else does.
Yeah.
So I called the system Costanza, as in George Costanza. Because remember the Seinfeld where he decided his life is wrong because he should do the opposite of whatever inclination he had to do.
Yeah. And
there's a lot of patterns. Linda's turtle soup system is like that. You're basically, you're buying against the trend, against the breakout. You're taking the pullback. You're expecting that the market's going to come down and take out the stops. So you bought it at a 20-day high, and now they're going to punish those people that bought it at a 20-day high and retrace to get them stopped out before the market continues higher. So that's the underlying premise. You have to ask, does this meet that criteria, which is taking money from the masses and giving it to a few people? If it goes against your natural inclinations, well, that's a really good thing.
That's an interesting insight there, Murray. Thanks a lot for sharing that. So what do you think is the most important ingredient to becoming a successful trader?
Well, I look at system trading particularly. Discretionary. See, here's the thing. Discretionary traders are born. A great discretionary trader that can do it day in and day out is like a great pitcher or a great hitter. They're born. A system trader only has to be in sync with the market when he's building his system. After that, the thing he needs to do is to trust what he's done and follow the rules. That's the big key. And I did a book called Trader's Secrets, which was also called Real People, Real Traders, Prentice Hall. And in that book, we interviewed non-famous traders that were very successful. And the underlying key is they understood their methodology well enough to trust it. Especially the system people. They trusted their methodology and they were able to trade it. And if they couldn't leave it alone, they were smart enough to give it to a broker to trade. I mean, that's really the issue. You have to trust the rules. If you don't follow your rules when you trade, you're going to lose.
Yeah.
I had a system way back when called iMaster that had a great 3-year run. And it's funny, I had a couple customers call me and I say, "Aren't you happy? The system made $8,000 on a mini Nasdaq this month." And he goes, "I lost money." I go, "How?" He goes, "Well, those 5 trades, I didn't take those because there was a new story about this, and there was a new story about that, and there was a new story about this." So he turned a system that won $8,000 on one mini Nasdaq contract and turned it into something he lost $2,500 on because he skipped trades because he didn't like the news. It scared him. So it's follow the rules. If you did your testing, you did your homework. Now that's also why when I sell systems, I sell disclosed code with a non-disclosure, because if you don't trust the system, you can't trade it. That's one of the big things. And people ask, and actually I want to answer this question. People always ask me, if your systems are so great, why do you sell them? Well, here's the issue. Most people can't follow a system. If I sell 100 copies of a system, my bet is there's only about 5 to 10 people that'll be trading it a year later, no matter how well it does. They'll be trading it exactly the way I intended, that aren't skipping trades, haven't stopped trading it because it went to a drawdown, trade it when they feel like it. There's going to be maybe, so here's the question. If I'm selling a system for $1,000 a copy, and I'm only going to have maybe 10 contracts in the S&P come in where I'm entering, why would I turn down $100,000 for that when only 10 or 15 contracts, maybe 20 contracts that are going to get traded where I am, and I got $100,000 I can use for research or I could use for trading.
Yep, that makes sense when you put it that way. Okay, how about what's your favorite trading books?
Okay, my favorite trading books, Perry Kaufman's, his giant system book that's got all that stuff in it. That's actually, to me, one of the most important books. With full disclosure, it has, the fact I like the book has nothing to do with that Kaufman references me in the book multiple times. It has nothing to do with that. It's a good book, in spite of that. Another good book was Trade. If you're just starting in trading and don't understand it, Trading for a Living is basically the first book on trading that I would give anybody if they know nothing at all about trading. So, like, if I was going to teach a secretary a little bit about trading that was only a secretary, that's probably where I would start her education. Now, in terms of if you wanted to have a handle on some more advanced topics, like let's suppose you wanted to study money management and trade allocation rules, Ralph Vince's books are very, very heavy. But he had a book that he self-published on leverage space, that's on Amazon. That's actually a good explanation of the book. And I actually wrote an article in Futures. You could look that up, explaining, almost like a preamble to read that book and explaining the concepts. And there's really an important concept in trading, and I want to really talk about this. And this is time. Let's suppose I'm trading, and I want to know, am I going to be profitable over the next 2 years? Now, I might have a system. Let's say I have a trend following system, and I have the benefit of hindsight. I know that I'm going to return 10% a year. Well, if my time window is 6 months to make a profit, there's actually a 50% probability I'm going to lose money over the next 6 months, even if over the next 5 years I'm returning 50% on my money. Because if you run through the probabilities, if I'm only winning 40% of my trades, you could run through the math that I could actually still be in the hole after 6 months, a year, maybe even a year and a half. With a relatively high probability.
Yeah.
So you have to understand these facts when you develop a group of trading systems to trade together, because otherwise you're going to get discouraged if over the first month or two or year the profits aren't what you expect. Well, what was the probability, even if everything worked perfectly, that your sequence of trades would have given you a return of more than 10% or more than 5% or even above zero, based on that? And that's actually what the leverage space concepts do for you. It allows you to calculate those probabilities on a portfolio of markets and systems. So, if my system returns 50% over the next 5 years, what is my probability of having a 20% return after year 2 or being profitable after 6 months?
Mm.
And that's an area no one really looks at when they're developing trading methodologies. Like you could optimize a series of trading methodologies so that I'm going to have the most profitable quarters. So because at the end of the quarter is when you get paid if you're managing money and you're getting an incentive, an incentive fee. So you might want to have positive quarters. You could develop a strategy that maximizes how many quarters you're positive at the end of the quarter.
Mm. Yeah, that's interesting. Yeah, thanks a lot, Murray. So what's the best way for listeners to get in touch with you?
Well, right now, one of the things I'm doing a lot of work in TradeStation, and I have my site usingeasylanguage.com. There's lots of free. It's a pretty good resource for tutorials and blogs about using TradeStation, as well as free code. And it's not junk free code. There's a lot of quality free code. For example, I have an Intermarket divergence tool that can only analyze one market at a time, but it's free. And it comes with my article that I did for IEEE, the peer review article. That's actually part of the free code package that's on the usingeasylanguage.com site. So all you have to do is register for free code. You could download, I think there's like 10 different free code items on the site right now.
Yeah.
And you could download those and you can take a look at it.
Okay, cool.
I have my Trader Studio product, and there's a site called traderstudio.com. There's a Murray at Trader Studio email I can be reached at.
Yeah.
And that email I check up probably every day or so. And, and we can, if we end up having a relationship, I can give you a private email that I answer at least 4 or 5 times a day if we're doing any sort of business or consulting.
Okay, thanks, Murray. I'll put those details up on the show notes page so that they're easy for people to find. So thanks a lot.
Okay.
So final question, is there anything else that you'd like to cover before we finish up today?
No, I think we've covered the whole history of technical analysis.
Yeah. Okay.
Not that I can think of.
All right. Well, thanks a lot for your time today, Murray. We did cover a lot of different topics there on system development, intermarket analysis, cycles, robust trading strategies, all that kind of thing. So thank you very much for sharing so much of your knowledge and insights with us, and for the time today. Appreciate all of that, and I wish you all the best.
Thank you.
Thanks, Murray. Bye. So, what did you think about the chat with Murray today? We covered quite a few topics, but 2 really stood out to me. The first was system premise. So one of the key points Murray came back to quite a number of times was understanding the premise of a system. In fact, Murray actually said, I think the premise is the most important part of a system, and also that there's lots of methods that can be robust as long as there's an underlying strong theory. So when you build a trading system, you need to have a valid premise and you need to understand the underlying theory of it. Another component Murray focused on was intermarket analysis. He actually said it was one of the most important areas in trading. Now, Murray covered intermarket analysis in the book he published 20 years ago, and the strategy still works today, so seems to be a very robust method. Now, if you want to know more or get started in intermarket relationships, you have 2 options. The first one is Murray has some free code on his website, which allows you to test relationships between 2 markets only. You can get that by going to his website, usingeasylanguage.com. However, if you'd like a more advanced intermarket analysis package, I managed to get Murray to put together a special deal for Better System Trader. Basically, it's a bundle of products which contains Intermarket Divergence Pro, a 3D optimizer, and an equity curve feedback tool, giving you everything you need to harness the power of intermarket divergence and equity curve feedback. But also, Murray is including a white paper which shows how to put this all together to create trading strategies, and the white paper includes an S&P system which combines 3 different market relationships, equity curve feedback, and a voting scheme to pick the best relationship. It's very cool, and the results are really interesting. So if you want more info, head over to the show notes page at bettersystemtrader.com/42, where we have additional details on the special deal from Murray, plus extra content and links for this episode. Additionally, if you have any questions or comments for myself or Murray, please post them in the comments section of the show notes page and we'll get back to you. So that's it for this episode. I hope you found a lot of value in the chat with Murray today, and I'll catch you at the next one. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.